Axsome Therapeutics, ticker AXSM. Second quarter, 2026. A double miss on consensus.
Yeah, a pretty clear double miss.
Right. Actual EPS came in at a loss of 99 cents, which misses the street's estimates. Those range from about an 85 to 89-cent loss by at least a dime.
Exactly, and revenue wasn't much better on paper.
Revenue was $218.4 million,
Mm.
missing the expected $221.9 million.
Right.
On the guidance front, management reported $319.9 million in cash and equivalents, stating this provides sufficient runway to fund operations, straight into cash flow positivity.
Which is a bold claim.
It is. But here's the crazy part for you. Despite the dual miss on the top and bottom lines, shares actually rose between 2 and 3% right after the report dropped.
Just trading right around that $217 to $219 mark.
Yeah. So our mission today is to look under the hood of these numbers, right? We need to find out exactly what institutional investors are seeing that those headline misses obscure. Why is the stock jumping on a day it misses both revenue and earnings consensus?
It's the ultimate puzzle for anyone watching the market right now. And to solve it, you really have to look past that binary beat or miss algorithm.
I mean, retail investors get so caught up in whether a company missed a highly synthesized Wall Street target by $3 million.
Right, exactly. But institutional money, they're looking at the trajectory. They're looking at the year-over-year momentum because, sure, overall revenue technically missed that very specific target, but the actual top-line growth is just explosive.
Explosive is the word. We're looking at overall product revenue being up 46% year over year.
Which is massive for a commercial stage biotech.
Huge. But this 46% growth isn't sprinkled evenly across everything they do. We have to talk about the absolute engine of this company right now, Auvelity.
Oh, absolutely. The star player.
Right. Originally approved for major depressive disorder. But here is a critical context. They just launched it in June 2026 for Alzheimer's disease agitation.
Right. Brand new market for them.
Yeah. And Auvelity generated over $180.3 million this quarter alone. That is a 51% year-over-year increase.
And the volume metrics tell the exact same story. I mean, total prescriptions for Auvelity hit roughly 266,000 for the quarter.
Wow.
Yeah, that's up 34% year over year. And crucially, it's up 12% sequentially from just the first quarter.
That consistent quarter-over-quarter compounding growth is like the holy grail for a biotech scaling a commercial asset.
It really is.
But I want to zoom in on that June 2026 launch for Alzheimer's agitation, because the numbers on this specific launch are, frankly, wild.
Oh, they're incredible.
Right. New-to-brand prescriptions for patients 65 and older jumped 126% in just the first 8 weeks following that launch.
Wait, 126%?
126% in an 8-week window.
See, that underlying signal is exactly what Wall Street is rewarding. To understand why a jump like that in that older demographic is so impressive, you really have to understand the reality of treating Alzheimer's agitation.
It's not just a patient feeling a little restless, right?
No, not at all. We're talking about severe behavioral symptoms. Pacing, physical aggression, extreme emotional distress, wandering. It's actually the primary reason these patients end up in institutional care.
Because families just can't safely manage them at home anymore.
Exactly. And historically, the market has completely failed these patients. Doctors have been desperate. They end up prescribing off-label antipsychotics to try and calm the patient down.
Oh, wow. But don't those have serious side effects?
Huge side effects. Those older antipsychotics carry severe black box warnings for elderly patients with dementia, including an actually increased risk of death.
So prescribers have been stuck between a rock and a hard place.
Completely. Which perfectly explains why there is a 126% jump. When you have a high unmet need market that desperate and you introduce a drug that actually works and has a different safety profile, doctors don't wait around.
They just switch their patients immediately.
Precisely. And Auvelity has a very fast-acting, unique mechanism of action. So this massive spike tells analysts that the drug's differentiated profile is actually working in the real world.
Not just in some highly controlled clinical trial.
Right.
Okay, so Auvelity is clearly carrying the team, but they do have a supporting cast contributing to that overall 46% revenue jump. We should quickly touch on Sunosi.
Yeah, their treatment for excessive daytime sleepiness.
Right. That brought in $35.8 million, which is a solid 20% year-over-year increase on about 61,000 prescriptions.
A very respectable, steady growth rate.
And then you have the recently launched migraine drug Symbravo, brought in $2.3 million, which is a 461% year-over-year jump.
Though obviously we have to caveat that it's coming off a very tiny baseline.
Exactly. But it makes me think of Auvelity as a franchise quarterback.
Oh, I like that analogy.
You look at the overall score of the game, the total revenue, and maybe the team fell slightly short of the spread. But your franchise quarterback just threw for record yardage, completing passes to a brand new demographic in that 65 and older Alzheimer's cohort.
Right. Wall Street is looking at that and saying, we don't care that you missed the spread by a field goal. The core asset is performing incredibly well.
They're rewarding the underlying strength. But, as any business owner knows, explosive segment growth doesn't just happen by magic.
No, it costs a lot of money.
Which brings us to the harsh reality of the income statement. Because we need to explain exactly why that 99-cent EPS miss happened. The net loss widened to $51.3 million.
Up from $48 million a year ago.
Right. So what drove that widening loss?
The primary culprit, the reason they missed the earnings estimate so significantly, is their SG&A, selling, general, and administrative expenses.
Okay.
That specific line item rocketed up 60% year over year to $208.1 million for the quarter.
$208 million in a single quarter just on overhead and marketing. If I'm looking at my portfolio, I'm thinking, why this sudden massive surge in spend?
It connects right back to that Alzheimer's agitation launch we just talked about. To get that 126% jump, Axsome had to aggressively expand their commercial footprint.
Right.
That $208 million was largely driven by fully staffing the Auvelity sales force to approximately 630 representatives across the country.
630 reps. That is a small army.
It is. But when you launch a drug for Alzheimer's, the prescribing base is highly fragmented. You aren't just talking to a handful of specialists at major hospitals.
You're reaching out to psychiatrists, neurologists, geriatricians.
And thousands of primary care providers in suburban clinics nationwide. You simply cannot educate that broad of a market with a skeleton crew.
It requires boots on the ground, travel, training.
Exactly. Heavy marketing collateral.
And interestingly, while they were spending heavily on the sales force, their R&D costs actually dipped 7% to $46.2 million.
Which is pretty common when a major trial wraps up and the commercial launch begins. Though management did note that R&D should ramp back up in the second half of the year.
Right. But I have to push back a little here on behalf of the retail investor.
Okay, let's hear it.
They grew revenue by 46%, which is great. But they had to hike their SG&A spend by 60% to get it. If marketing spend is growing faster than revenue, is that actually a sustainable business model?
It's a fair question.
Are they just buying their market share right now? Because, anyone can grow sales if they spend $2 to make one.
Yeah, and that is exactly the mechanism that institutional analysts drilled down into during the earnings call. The answer really lies in operating leverage.
Okay, unpack that for us.
I want to highlight CFO Nick Pizzi's specific commentary here because it's basically the linchpin of the bullish thesis for this stock. He stated that SG&A is expected to plateau right around this $208 million mark now that the sales team is fully built.
Meaning the heavy lifting of hiring and training is officially done.
Exactly. Think of it like building a massive toll road. The initial construction costs are astronomical.
Right, paving all those miles.
But once the road is built and the toll booths are staffed, every additional car that drives on it is almost pure profit. The sales team of 630 reps is fully deployed. From here on out, operating leverage should kick in.
So if SG&A stays flat at $208 million, but those reps keep driving quarter-over-quarter prescription growth for Auvelity,
then future revenue growth doesn't require a proportional hike in expenses. Those new revenue dollars start falling straight to the bottom line.
Ah, okay. So they're telling Wall Street, this quarter was peak pain, we bought the expensive machinery, trained the army, and now we just let them execute.
Right. But right now, they're still burning cash, losing that $51 million this quarter.
Yeah, and because of years of development, their accumulated deficit has now reached $1.42 billion to date.
That is a massive historical cash burn.
So the investment thesis here relies heavily not just on Auvelity, but on future pipeline approvals to justify that billion-dollar hole.
Absolutely. One successful drug rarely covers a decade of R&D for an entire portfolio.
So let's pivot to that pipeline. Management estimates a total annual peak sales potential of over $18 billion across their central nervous system portfolio.
18 billion. Just to put that in perspective for you, their total revenue this quarter was about 218 million.
Right, so they are projecting an entirely different stratosphere of future scale. Let's look at the clinical catalyst that might get them there. First up is AXS-12.
Yeah, so the FDA just officially accepted the new drug application, or NDA, for AXS-12. This is a treatment for cataplexy and narcolepsy,
Okay.
and it has a locked-in PDUFA target action date of May 1st, 2027.
So the PDUFA date, for those listening, is essentially the federally mandated deadline for the FDA to render a final decision on whether to approve the drug or not.
Having that date locked in gives Wall Street a very specific milestone to model.
But let's talk about the drug itself. Why is cataplexy such a massive focus?
Cataplexy is a sudden, transient loss of muscle tone. It's almost always triggered by strong emotions, laughing, crying, surprise.
That sounds terrifying.
It is incredibly debilitating. Imagine you're at work, someone tells a joke, you laugh, and suddenly your knees buckle, or you completely collapse to the floor while remaining fully conscious.
Oh, wow.
It makes living a normal, independent life nearly impossible for these narcolepsy patients, and the current standard of care leaves a lot to be desired. AXS-12 has shown it can significantly reduce these attacks.
So again, a high unmet need market where a differentiated mechanism could instantly capture share. But the pipeline story isn't just about entirely new drugs, right?
No, it's also about expanding the drugs they already have. Let's look back at solriamfetol, which is the active ingredient in Sunosi.
Okay, what are they doing with that?
They are pushing it far beyond its current use for excessive sleepiness. They just initiated 2 massive phase 3 trials called FOCUS-2 and FOCUS-3 to test the drug in pediatric and adolescent ADHD.
But ADHD is a highly saturated market. You've got Adderall, Ritalin, Vyvanse. Why expend capital going after a space that crowded?
Because the market is desperate for novel, non-stimulant or differentiated options. We've all seen the headlines about stimulant shortages.
Right, and the side effects.
Exactly. Many parents hesitate to put their kids on traditional treatments. The preliminary data for solriamfetol here is highly compelling. In a previous adult study for ADHD, it showed a statistically significant 17.7-point reduction in ADHD symptoms.
A nearly 18-point reduction. That's huge on those clinical scale.
It is massive. If they can replicate that kind of robust efficacy in children and adolescents and prove it's safe, it opens up a multi-billion-dollar total addressable market instantly.
When you look at all of this together, Alzheimer's agitation, narcolepsy, pediatric ADHD, and I know they're even starting trials for smoking cessation, it feels like an incredibly aggressive land grab.
It really does. They're pushing multiple assets simultaneously into massive, highly complex markets.
But you use the phrase land grab, and we have to be realistic here. A massive total addressable market on a PowerPoint slide is wonderful, but execution is everything.
Execution is the only thing that matters in the real world of biopharma.
Right. So let's bring this back down to earth and examine the immediate risks that you, the retail investor, need to weigh. We have a company burning $50 million a quarter, armed with a pipeline full of expensive late-stage trials. What is the actual profitability timeline?
According to the sell-side consensus, 2027 is expected to be Axsome's first truly profitable year. Current estimates point to a positive EPS of $4.06 for that full year.
A $4 positive EPS in 2027 sounds great, but we're sitting here in mid-2026. That means they have to cross a pretty wide valley to get to that promised land.
And that valley represents significant execution risk. Remember that $319.9 million cash pile management touted?
Yeah, they said it was enough to last until cash flow positivity.
Right. But the math behind that claim has a razor-thin margin for error.
Let's pull on that thread. To make that $320 million last without diluting existing shareholders, 2 things absolutely must happen. 1, Oyuvality has to maintain its steep growth curve, especially in this new Alzheimer's demographic.
If that 126% jump flattens out, the revenue engine stalls.
And 2, CFO Nick Pizzi has to be right that $208 million SG&A spend truly has to be a plateau. If costs creep up, because reaching primary care doctors is harder than expected, that cash runway shrinks incredibly fast.
And if we connect this to the clinical calendar, the risk profile gets even sharper. What happens if the FDA pushes back that May 2027 date for AXS-12?
Or what if the phase 3 binge eating disorder data, which is due in Q4 of this year, disappoints? Can this balance sheet actually handle a clinical delay?
It would be very tight. The current operating plan assumes steady, predictable regulatory progress. Any deviation means they are burning $50 million a quarter longer than expected.
Now, to their credit, they have 0 debt problems right now.
Which is a massive strength. But equity markets are incredibly unforgiving if a biotech misses a major endpoint and suddenly has his hat in its hand asking for cash.
So let's look at the whole board here. We have a company with an $11 billion market cap, zero debt, a fully staffed 630-person national sales force, and a pipeline allegedly worth $18 billion a peak.
It leaves you with a really strategic question to chew on.
It does. Is Axsome's ultimate goal to grind through the execution risk of the next year and emerge as a standalone CNS commercial powerhouse? Or are they purposely building out this massive sales force right now to make themselves an irresistible turnkey acquisition target?
Think about the mega cap pharma companies facing massive patent cliffs over the next 3 years. They are desperate for growth.
Would one of them love to just swallow an $11 billion company, plug their own future drugs into that fully trained 630-rep sales force, and immediately capture an $18 billion pipeline?
It's the ultimate build-or-sell dilemma.
Definitely something for you to mull over as we head toward that critical 2027 profitability target. Make sure you hit follow on the show right now so you don't miss our daily, no-nonsense earnings coverage. We will keep tracking Axsome and the rest of the market. See you on the next deep dive.